Welcome to today's episode of Heard and Seen Around. I am Rajesh Karipurath. This is my take on macroeconomic and geoeconomic data points which I find interesting. I hope you enjoy watching it as much as I enjoyed curating it. Cheers.
Every boom begins with conviction. Every bust begins with the same conviction. Supply chains are invisible until they stop working. The future is always digital. The problems remain stubbornly human. We speak of global stability as if it were a product with a warranty. We trust algorithms because they sound objective. They're just faster opinions.
9 of the world's top 10 richest live in one country, United States. That's not luck, that's a system. From Elon Musk to Jeff Bezos to Mark Zuckerberg, this is an inheritance-heavy wealth. It's equity-driven, tech-powered compounding. Notice the pattern. Platforms, network, scale. Build once, monetize globally. Meanwhile, the only outsider, Bernard Arnault, sells luxury to guess who? The same global wealth machine. Foreign investors are hitting the exit button quite hard. Across the Asian emerging markets, over $50 billion has been pulled out in a month, blowing past even pandemic and war-era sell-offs. The pressure is sharpest in India, South Korea and Taiwan. Why? It's not just risk off, it's oil exposure. Asia consumes nearly 80% of the crude flowing through the Strait of Hormuz. So any disruption from the Iran conflict hits growth, inflation and currencies all at once. For global funds, that's a triple risk. The capital leaves before the data worsens. India may miss its FI26 road target, but the bigger issue is in kilometers, it's a commute time. India has built thousands of kilometers, yet daily speeds still crash at tolls, choke points and unfinished stretches. Infrastructure is being counted, not experienced. Execution is a gap. Land acquisition delays, patchy clearances and projects awarded before they are truly ready. So on paper, highways expand. On ground, friction remains. Because infra isn't just about length, it's about flow. Until that improves, more roads won't mean faster roads. For years, the United States dominated with a capital light market. Software platforms and margins without massive reinvestment. But that model is being stress tested. AI is not cheap. The hyperscalers, think Microsoft, Amazon, Google, are pouring billions into data centers, chips and power. Suddenly the most asset-light market is quietly becoming asset-heavy. This is a structural shift from code to concrete, from margins to capex cycles. While headlines scream crisis, the plumbing tells a calmer story. India's bank credit growth is back at 15%, a clear sign that domestic demand hasn't blinked. Yes, global noise may slow things down for a quarter or two, but credit is the economy's heartbeat, and right now it's steady, not stressed. This isn't 2020 style collapse, it's more like a temporary speed bump in an ongoing cycle. If credit holds, growth follows, it usually does. On paper, the Indian rupee is already undervalued. The REER, which is the real effective exchange rate, below 100, across baskets says that clearly. But here's the twist. That measure misses services where India dominates. So the currency looks cheap using a framework that ignores a huge chunk of its export strength. If you priced in IT, consulting and digital services, the rupee might not just be undervalued, it could be materially mispriced. Which means two things. Stronger export competitiveness today and potential appreciation pressure over time. The model says cheap. The reality might be cheaper.